Welcome to Earnings Recap. Today we're covering Shell's earnings report and earnings call January-March 2025. If you enjoy this kind of content, please like the video and subscribe to the channel.
Exactly. And what we're aiming to do here is really just break down Shell's latest performance and the discussions around it into plain English.
Right. We want to give you the key takeaways without you needing to sift through, dense financial documents.
We've looked at Shell's first quarter 2025 results earnings call transcript and also their official Q1 unaudited results document. Those are our main sources.
And our mission really is to pull out the crucial bits, the key numbers, what management is saying, the outlook, so you can get a quick, solid understanding of how Shell did in the first part of 2025.
So we'll tackle this in two parts. First, we'll hit the main financial figures from the earnings report itself. Think profit, cash flow, debt, that kind of thing.
And then second, we'll dig into the earnings call highlights. What questions did analysts ask? What was management's commentary? What's their view looking forward?
Sounds like a plan. Let's get started with those Q1 numbers.
Okay, so first off, the overall financial picture. The headline number, income attributable to Shell Plex shareholders, that actually went up compared to Q4 2024.
Yeah, it did. And the main reasons for that were fewer write-offs this quarter, which helps. Lower operating expenses, too.
And higher margins in their products division. That seemed important.
Definitely. But it wasn't all positive on the bottom line. There were some offsets.
Right, like that charge for the UK energy profits levy. About $500 million.
Yeah, that was one. And some impairment charges, too. So when you factor those in, there was a net loss from what they call identified items of about $0.8 billion.
Okay, but looking underneath that, at their core performance metric, adjusted earnings, how did that look?
Much better. Adjusted earnings were $5.67 billion. That's quite a jump from the $3.77 billion in Q4 2024.
So a strong rebound in underlying profitability then.
Exactly. And that flows through to the per share number, too. Adjusted earnings per share hit $0.92.
Up from $0.60 quarter. That's a pretty significant increase per share.
It really is. Now let's switch gears to cash flow. Always critical.
Absolutely. How much cash did the operations actually generate?
Cash flow from operating activities was $9.3 billion. Pretty healthy. That was mostly driven by their adjusted EBITDA.
EBITDA, so earnings before all the interest, tax, depreciation stuff, a good measure of operational cash generation.
Right. But that $9.3 billion wasn't all free and clear. They had tax payments of $2.9 billion.
Okay.
And also working capital outflows of $2.7 billion.
Working capital. So timing differences in payments and receivables.
Mostly, yeah. Accounts receivable and payable movements were the main drivers there. So that ate into the operating cash flow number.
Got it. What about cash used for investing?
That was an outflow, as you'd expect, $4.0 billion net outflow from investing activities.
And what made up that number? Mostly capital expenditure, I assume.
Yep, $4.2 billion in cash capital expenditure, plus another $1.9 billion in net other investing outflows. That includes things like loan drawdowns linked to that Nigeria onshore divestment.
Interesting. Were there any inflows from selling assets?
There were. About $7.6 billion came in from divestment proceeds, so they are actively churning the portfolio a bit.
Okay. And speaking of cash flows, how about returns to shareholders? Always a big focus for Shell.
Very much so. They announced another big share buyback program, $3.5 billion this time.
Wow, $3.5 billion, and they plan to get that done pretty quickly.
Yeah, the goal is to complete it by the time they announce Q2 results. And, this is the 14th quarter in a row they've done buybacks of $3 billion or more.
14 quarters straight. That's quite a commitment to returning cash via buybacks.
It really signals confidence, and on top of that, the dividend per share stayed the same at 0.3580 cents.
So, steady dividend plus significant buybacks. Okay, how did all this affect their debt position?
Well, net debt did increase. It went up to $41.5 billion from $38.8 billion at the end of last year.
And what drove that increase? Was it just the shareholder returns?
That was a big part of it, yes. The free cash flow they generated wasn't enough to cover the buybacks and dividends, but also lease additions, including from the Pavilion Energy deal, and interest payments played a role.
Right, Pavilion Energy, we'll come back to that. So higher net debt means higher gearing too.
Correct. Gearing rose to 18.7% from 17.7%. Still within a manageable range for a company like Shell, but definitely higher.
Okay, that covers the main financial metrics. Let's talk about how the actual operations performed. How was oil and gas production?
Total oil and gas production available for sale was actually up slightly, about 1% compared to Q4.
Just a small increase then. What about within that? Integrated gas.
Integrated gas production itself was higher, mainly because their Pearl GTL plant finished its turnaround maintenance.
So that's back online properly? Good. But LNG volumes?
LNG liquefaction volumes were actually lower. They had some unplanned outages down in Australia that impacted things.
Right. Always operational hiccups somewhere. How about upstream finding and producing the oil and gas?
Upstream continued to show really high controllable availability. Places like Norway, Nigeria, offshore, Kazakhstan, all above 98%. So the assets they control are running very well.
That's strong performance. And the downstream side, marketing.
Marketing, which is mobility and lubricants, had a very good quarter. They saw increased margins, especially on their premium products.
So selling the higher value stuff is really paying off there.
Seems so. Lubricants, in particular, just keeps performing record levels, it seems.
What about chemicals? That's been a tougher spot for them, hasn't it?
Yeah, chemicals margins are still low. It's a challenging market, but they do expect some improvement now that they've completed the sale of that Singapore complex.
Because that was losing money.
Apparently so. Divesting it should help the overall chemicals segment performance. And one more operational point refinery utilization jumped up.
Oh yeah, to a level.
Up to 85% from 76% in Q4, so they are processing more crude oil.
Okay, so a mixed bag operationally, but some definite strengths in upstream availability and marketing margins. Now, you mentioned portfolio changes earlier. What were the big moves in Q1?
Well, a significant one was completing the acquisition of Pavilion Energy. That really boosts their LNG trading capabilities.
Right, a big strategic move in gas. Any new production starting up?
Yes, 2 major projects came online. The Whale floating production facility in the Gulf of America.
Okay.
And the Penguins FPSO in the UK North Sea. Both Shell operated.
Big projects finally delivering. Good to see. Any other investments?
They also signed a deal, which actually closed May 1st, to increase their stake in the Ursa platform, another one in the Gulf of America.
So doubling down on some existing assets too, and on the divestment side.
They completed the sale of their onshore Nigeria business, SPDC.
That's been a long time coming.
It has, and also that energy and chemicals park in Singapore we mentioned.
Just so cleaning up the portfolio. Are they sanctioning new projects too?
Yep. Final investment decisions, or FIDs, were taken for Gato do Mato, which is an oil project in Brazil.
Okay.
And also for Phase 2 of the Northern Lights carbon capture and storage project in Norway.
Interesting. So investing in both traditional energy and transition technologies.
Seems to be the strategy, balancing both.
All right. That gives us a really good picture of the Q1 report itself, the numbers, the operations, the portfolio moves. Now let's shift to the earnings call. What were the analysts focused on? What was management saying?
Yeah, the call is always interesting. One of the first questions from Josh Stone at UBS was about capital allocation, specifically being counter-cyclical. How did they decide where to put money when things are uncertain?
Good question. How did they answer?
Management basically stuck to their script, focus on unlocking value, driving that 10% plus free cash flow per share growth by 2030.
And buybacks play a big role in that.
Huge. They explicitly called buybacks value hunting right now because they see their share price as advantage compared to their free cash flow yield.
So buying back shares is a top priority for using cash.
Absolutely. They recommitted to that 40-50% of CFFO distribution range, and they said any acquisitions, any inorganic moves face a really high bar. They have to clearly show a path to boosting free cash flow per share.
Makes sense.
Yeah.
Did Josh Stone also ask about integrated gas trading? LNG specifically?
He did, and management said, look, Q1 was a very good quarter for LNG trading. Assets performed well, despite a couple of glitches like prelude downtime and some weather in Australia. Demand was strong, optimization worked well, so margins were good.
What about the outlook for Q2 in LNG?
They flagged some planned maintenance for Q2, so liquefaction volumes might be similar to Q1, but they did caution that lower LNG prices now, plus some legacy hedging losses, could pressure Q2 earnings.
My cash flow should hold up.
They expect cash flow to be resilient, yeah. Partly due to some non-cash hedges and working capital unwinding.
Okay. Then Peter Lowe from Redmond Atlantic asked about the CapEx budget, that $22 billion for 2025. How flexible is that?
Management basically said, we set that budget based on our strong position, and we intend to stick to it. They like to deliver on promises.
But do they have flexibility if they needed it?
Oh, yeah. They pointed back to the COVID period, saying they proved they can pull back if needed. But right now, they don't see the need. They see opportunities like increasing that Ursa stake, and they want to pursue them.
Peter Lowe also asked about that Singapore disposal of the chemicals park. What's the expected financial impact?
They expect it to help both refinery and chemicals margins, since it was apparently loss-making. And it should also contribute, several $100 million annually to structural cost reductions.
So a clear benefit from selling that asset.
Seems so. Then Lydia Rainforth from Barclays had a good question about real-time demand. What are they actually seeing on the ground?
Yeah, given their global reach, they should have a good view.
And they said, despite all the macro noise, demand for oil products, and LNG is holding up pretty well right now. LNG demand is getting a boost from low storage levels in Europe.
And crude markets.
They see crude and product markets as pretty well balanced currently. They're watching key things like bunker fuel, diesel, jet fuel, gasoline, especially in the US and China, given the tariff situation.
Lydia also asked about progress on reducing operating expenses, OPEX.
Right, a big focus area. Management sounded quite positive, saying there's real momentum now. It's moving beyond just top-down targets to ideas coming up from the organization.
What kind of ideas?
Things like supply chain optimization, avoiding really long, complex projects, delayering the organization, simplifying the corporate center. They think there's still more to go after.
Interesting. Paul Chang from Scotiabank shifted focus a bit, asking about Shell's organizational capability. Are they actually ready culturally to do a big acquisition after all the recent changes?
Yeah, that was an insightful question. Management talked about their strong foundational culture, ethics, safety, care, and how they're trying to add this winning performance culture on top.
Hunger to win, continuous improvement, that sort of thing.
Exactly, but they admitted there's still work to do to fully embed that. So the message was, big M&A only happens when the house is truly in order, culturally and operationally. They used Pavilion Energy integration as a recent positive example, though.
So, cautious on huge deals for now. Paul also asked a tough what-if question. If Brent oil drops to, say, $40 and stays there, what gets cut first, CapEx or buybacks?
Right, they modeled it out. At $50 Brent, they think they'd make $35–40 billion CFFO, enough to cover dividends and still do decent buybacks within their 40–50% payout range.
Okay, but at $40 sustained.
At $40, the absolute priority becomes covering the dividend, maybe hitting the low end of that 40–50% range, but they stressed they'd try to keep buybacks going as long as possible because, well, lower share prices make buybacks even more attractive mathematically.
Good point. Value hunting again. Biraj Borkhataria from RBC wanted clarity on the cash impact of recent deals, Pavilion Singapore.
Yeah, he wanted to know the near-term cash effects. For Pavilion, Shell said the main impact was lease additions, hitting net debt by less than $1 billion. Minimal earnings impact expected in 2025, more in 2026.
And Singapore.
That sale brought in about $600 million in cash proceeds in Q1. And because it was loss-making, selling it improved free cash flow going forward. Net-net, they said the Nigeria and Singapore divestments are roughly free cash flow neutral for now, but the OPEX savings will build through the year.
Biraj also asked about upstream costs after the Nigeria sale, OPEX and DD&A. Is Q1 a good guide?
Management suggested the Q1 run rate for OPEX is sensible, with more improvements expected. The lower DD&A and write-offs in Q1 were partly due to reserve updates they did back in Q4 24.
Okay. Giacomo Romeo at Jefferies circled back to Pavilion. Boy, minimal earnings this year, but more expected next year.
It's down to the timing of the contracts they acquired, derivatives versus physical delivery. The real value unlock comes in 2026, they think, when they can fully integrate those contracts, the ships, the regas access into their trading and optimization machine.
So it takes time to extract the value. Giacomo also asked about that $50 oil scenario again, what CapEx gets cut first.
They didn't give specifics, just reiterated their dynamic capital allocation approach. They look across everything upstream, downstream, M&A, buybacks, debt reduction based on market opportunities. They did mention the kind of maintenance CapEx level seen during COVID was below $18 billion, and the current budget includes $1–2 billion for potential M&A, hinting where flexibility might lie. Prudence is key.
Got it. Henry Tarr from Berenberg wanted to know more about the strength in marketing. Was it just good markets or specific self-help actions by Shell?
Good question. For mobility, they pointed to ongoing cost reduction, better advertising spend, and that continued push on premium fuels driving margin.
And lubricants.
Just continued strong performance, high margins driven by premium product sales. They seem to be nailing it in lubricants consistently.
Henry also asked about renewables and energy solutions. Any signs of life there, given the challenges?
Management acknowledged it's tough overall in what they call sectors and decarb, but there are pockets of strength, like trading around U.S. tariffs. Challenges too, like in their Ryzen venture in Brazil, crop issues, interest rates. They're optimizing biofuels within trading and mobility and basically monitoring things closely.
Right. Matt Lofting at JP Morgan specifically asked about the impact of those U.S. tariffs.
Shell said the direct impact so far is limited and manageable. It's more on their supply chain than energy sales. They're mitigating, like adjusting steel purchases for projects.
But they're watching for wider economic effects.
Yeah, they're monitoring potential second-order impacts on the economy and supply demand heading into 2026.
Matt also commented on the consistent outperformance in upstream and integrated gas. What's behind that, and can it last?
Management credited their internal performance improvement drive. Teams running assets well, focusing on maximizing output, cost discipline, simplification. They gave the Prelude recovery example much faster than before. They expect that drive for cash and performance to continue.
Sounds like an internal cultural shift almost. Martin Ratz from Morgan Stanley asked about the market for selling assets now and about LNG Canada's startup.
On disposals, they feel they've made good progress already. Nigeria, Singapore, Pakistan. The focus now is delivering that free cash flow per share growth, which they say isn't mostly tied to oil prices anyway.
How is it not tied to oil price?
They believe a lot of that 10% plus growth comes from buybacks and things they control, OPEX cuts, CapEx flexing, transforming downstream and renewables, a chemicals recovery, turning around the retail business, trading upside.
Okay. Lots of internal levers. And LNG Canada.
First cargo expected mid-2025. But the really significant impact on volumes, earnings, and cash flow will build towards the end of the year as both trains ramp up.
Roger Reed at Wells Fargo brought up cost savings again. Is there more urgency if oil prices fall? And how do acquisitions fit with buybacks?
On costs, they said the agenda is critical regardless of oil price. It's about lean operations, operational alpha, not just cutting, but using AI, supply chain improvements for productivity. Strong internal urgency.
And acquisitions versus buybacks.
Value creation is the North Star, measured by free cash flow per share. Buybacks look great when shares are cheaper. They're not reluctant to do deals, but the bar is very high. They feel they have flexibility with a strong balance sheet and an attractive organic portfolio, too.
Christopher Coupland from Bank of America asked about lessons learned from past capital decisions and the Rotterdam Biofuels project pullback. Also, why was marketing CapEx low in Q1?
They acknowledged past projects sometimes got too complex. Lessons learned, focus on digestible opportunities, risk-adjusted returns. Rotterdam is paused due to current biofuel market conditions, oversupply, mandate changes. Just prudent capital allocation, they said.
And the low marketing spend.
Q1 is typically low for marketing CapEx. Plus, the team is raising the bar, asking if capital is better spent elsewhere, like buybacks or upstream. Dynamic allocation again.
Lucas Herman at BNP Paribas dug into chemicals, the strategic review, utilization rates, and he had a question for the CFO on reporting changes.
On chemicals, they said there's significant inbound interest for partnerships or deals, but it's not a fire sale. They want the best long-term value. The lower utilization guidance, 74-82%, reflects shutting down cash-negative units strategically.
Okay. And the reporting change in marketing.
The CFO, Sinead Gorman, explained it was about simplification, removing less used data points while still providing key metrics like adjusted EBITDA quarterly.
Makes sense. Lastly, Doug Legate from Wolfe Research pushed on using the balance sheet for buybacks if needed and progress on that big cost savings target.
Management said yes, they're comfortable leaning on the balance sheet for buybacks if needed. That's what it's there for. They feel the buyback part of their per-share growth target has upside potential right now.
And the $7 billion cost savings, where are they?
They said $3 billion was done by end of 2024. The next phase is more structural, internal changes. The recent divestments will remove several $100 million more OPEX this year. They sounded confident about hitting the full target.
Okay, so wrapping this all up, it feels like Shell delivered a pretty solid Q1 overall.
Yeah, strong results, another big buyback showing confidence. They're clearly continuing to reshape the business, and management sounds pretty upbeat despite, the usual uncertainties.
Their core message seems consistent. Deliver value, lower emissions, and keep rewarding shareholders through dividends and those substantial buybacks.
Exactly. That focus on shareholder returns alongside managing the transition seems central.
Well, thank you for joining us for this deep dive into Shell's latest earnings.
As a final thought for you to consider, how will Shell's balancing act returning cash now versus investing for the long term, navigating oil prices versus the energy transition actually play out over the next few quarters? especially with all the economic and geopolitical shifts happening globally. Something to keep an eye on.